Yeah, flat. Internal, okay. Thanks. So,
Welcome. Good evening, everyone. Good evening, and welcome to our first financial reportings lecture section, paper 2.1 of the ICAG CA professional qualification. Welcome.
Thank you.
And I get some reactions. You can unmute. I'm Bernard. You can unmute. Let me hear from you. Okay, Samuel, Veneza,
Thank you.
Princess. Good evening. Omar, your hand is up. Feel free. It's a live section, so please try as much as possible to unmute. Omar, don't put your hand. Just unmute and let's hear from you. An open class. Do you have people joining from University of Ghana? Alumni University of Ghana. Okay, UCC Central University. Good evening.
Yeah, UCC.
Please, do you get any feedback from my end?
No, please.
Okay, there's no feedback. Okay, that's fine. Thank you. All right, so this is an exciting journey that we're about to begin. Financial reporting paper 2.1. One of the exams is very mechanical. It's easier to pass an Excel effort. My sole responsibility is to build you in terms of theoretical and technical knowledge in financial reporting standards, and also prepare you to attempt and pass your ICAG exams this coming November 2nd. Right, so I'm ready. Let's get started. Kindly know that the meeting is recorded and it will be hosted on our YouTube channel. So after this live section, if you want to replay a video, it will be available within the next 24 hours. At any point in time where I'm presenting and you have any question, please feel free, unmute and let me hear you. Please don't wait for me to finish with lectures before asking questions. It's a live interactive section, not a sermon. So at any point in time where I'm moving too fast or you want to share any idea whatsoever, please feel free. And let's have a healthy interaction. All right, thank you. The brief outline of this module, right, requires you to have some accounting knowledge, and we would build some level of technical expertise when it comes to IFRS. And so that's what paper 2.1 is looking for. There'll be a few financial statements, analysis, and interpretation that you'll be required to do. Ethics is a foundational knowledge that accountants are required to possess, and even every professional is supposed to possess. So there'll be a bit about ethics. We'll look at the regulatory framework of the IAS, conceptual framework of financial reporting. We'll delve deep into application of accounting standards. We'll look at single entity financial statement. We will be looking at group structure. Here, our focus will be on the parent subsidiary, and in some cases, an associate. We'll be evaluating financial statements, and the last point is where we get at ratios and financial statement analysis. Let's start with some big issues. We are looking at the regulatory framework for financial reporting. Let me just ask a few questions. I hope you all know football, right? Football. You know football is regulated, right? Let me get some reactions. Football is regulated, right? This one news. There's enough of the reactions. Please complete. Football is regulated. And
Yes,
on
yes,
the
please.
international front, the way that you know who football on the international front. We just ended the FIFA World Cup. I've said it. You know who regulates football on the international front?
FIFA.
Yeah, FIFA.
FIFA.
Good. And what about on the local front? Do you know who regulates football on the local front?
GFA.
GFA. Okay. So in football, there's some level of regulation, and there's some bodies, authority that regulates or guides how football is supposed to play. League. The number of minutes football is supposed to last, the various rules, right? That guides or help the game run. So in football, you realize that there are bodies, there are rules that help the game run. So that when you are watching football and you are watching, let's say, the EP, and they flash a yellow card, you know the interpretation of that yellow card if you are also watching what football in Ghana. So you realize that that form of regulation and countries trying to join that regulation has resulted in some form of easy understanding of the game. So it's easier to interpret football, whether it's played in Ghana or whether it's played in the UK or whether it's played in Europe. Much the same way, accounting too has this regulation that help us to interpret transactions and explain concepts, whether it is in Ghana or it's in the UK, right? So that is all about regulatory framework for financial reporting. So at the international stage, it is IFAC that regulates accounting. That's the International Federation of Accountants. And at the national level is the Institute of Chartered Accountants Ghana. It is by virtue of the ICAG's regulation of accounting practice in Ghana. That is why we are all here. Because the ICAG requires that if you want to become a professional chartered accountant, the ICAG law, there should be some form of education and there should be some form of what training. With the training, we are looking at 3 years post qualification experience, then you become a chartered accountant. So the ICAG regulates accounting practice and accounting education in Ghana. IFAD began somewhere in 1977, right? And we have a lot of countries that joined. The founding members were 63. Currently, when you look at 2022, we have 130 jurisdictions worldwide that uses or that subscribe to IFAD. And the purpose of developing IFAD was to ensure that there is high quality international standard in auditing and assurance, public sector accounting, ethics, and education for professional accountants, and supporting their adoption and use. That is why the IFAD helps to develop accounting standard, help to develop audit standard, help to develop public sector standards. The body also helps to collaborate and cooperate among it looks at some of what cooperation. One typical cooperation that's it's evident for us is when you take the ICAG. The ICAG has healthy cooperation with the Institute of Chartered Accountants, England and Wales. England and Wales actually were the consultants that established the ICAG's current syllabus, right? So you realize that most of their existing manuals were supported by, its publication was supported by the Institute of Chartered Accountants, England and Wales. So IFAD helped in that healthy collaboration. Fun fact, ICAG was a member of IFAD when IFAD was founded in 1977, right? So this is just a snippet from the IFAD's website. And when you look at their team, we are a global voice for accountancy profession, right? So they serve as an authority when it comes to the accounting profession in the world. There are 4 boards under IFAD. We have the Institute of International Accounting Standards Board. We have the International Ethics Standards Board. We have the International Audit and Assurance Standards Board. And we have the International Public Sector Accounting Standards Board. So usually when you have S close to B, it means Standards Board. And almost all the I's are international. For accounting, FR and corporate reporting, we'll be focusing our attention on the IASB, that's the International Accounting Standards Board. That's the board that is responsible for managing accounting practice in the world. Those being public sector, you realize that you have to be looking at some of the international public sector accounting standards. And those public sector accounting standards are developed by the International Public Sector Accounting Standards Board. For those who be doing either audit and assurance or advanced audit and assurance, whether level 2 or 3, those international standards on audit are developed by the IAS. For all of us, whether it is audits, whether it's accounting, or whether it's public sector accounting, we are guided by what? Ethics. So we would have to look at the framework that is set by the International Ethics Standards Board for accountants. So just to give you a pictorial idea, our focus from now will just be on the IASB. Okay, so we'll be focusing on the IASB. Okay. The Institute of Chartered Accountants Ghana was established by an Act 1058, but this act has been amended and repealed by a new Institute of Chartered Accountants Ghana Act. The objective or mission for establishing ICAG is to produce professional accountants of the highest quality, ready to provide cutting-edge services to their clients at all times and upholding the ethical values of the accountancy profession. right? So the vision of ICAG. You can't become a member of ICAG, Alice, without not knowing why the ICAG has been established. In most instances, we do this professional or we undertake this professional journey because of probably career or the pressure from work to get this qualification. It's a very requirement for unemployment. So we do it. But at the end of the day, you are going to belong to professional body of a reputable caliber. It's important, at least we spend some few minutes researching on the IFAC and the ICAG. Right, so that gives us a bit about the regulatory framework for professional accounting in Ghana and in the world. I'll just open the floor and ask a few questions. With this regulation, with accountancy profession being regulated, I want to ask, do you think that there's any value, right, for ensuring some level of global accountancy regulation? Do you think that there's any value? Please unmute and let's have a discussion.
Hello, sir.
Hello.
Yes, please. The regulation of the accounting profession, the ICAG, helps the ICAG to oversee the accounting profession in the country so that the product of their work, their financial statement, can be comparable to other countries that are also under the umbrella of the IFAC.
Okay, fantastic. So you're looking at quality of report, you're looking at comparison of reports, right? That's fantastic. So regulation brings some form of quality, right? That's very impressive. And you realize that once there is quality report, you realize those who take financial decisions or economic decisions can place some form of reliance on those reports. Okay. Any other point from what we've discussed so far? Yes. The best way to do this is to have an interactive class. I beg you. Hiding behind and giving us the thumbs up, it's okay. So somewhere around 7:30, getting to 8, when I know that at least you should be home, uh, I would encourage some form of voice participation.
Let me go then. I think some benefits of having a regulatory,
Okay.
but
Yes, we are
there's
looking at the IASB's conceptual framework for accounting. When we talk about a conceptual framework, it simply means a common way of thinking or reasoning for a group of professional bodies. So when you look at the legal profession, there's a way they think, there's a way they behave based on their training, right? Based on their training and education, you realize that you wouldn't find it easy entering into a significant oral contract or verbal contract with someone who has been trained as a lawyer. Whether you are their relative or you are their siblings, they would want to have some form of written on evidence. So because that's a way the profession has trained them. If you've ever been among military men or service people, realize that they are security conscious. That's a conceptual way of thinking, right? So when it comes to accounting, the profession is such that there is some conceptual way or there's some structured way that we think. And that structured way of thinking is sometimes guided by what? Guided by concepts and definitions that we have come to what to all agree. So when you say something is an asset, I also see it as an asset. You get it. So for instance, you can't tell me that you have an employee, and that employee is an asset. So that asset should be recognized in your books because that employee is so hardworking. In some instance, your definition might be right, but in some other instances you might be wrong. So you realize that the profession has come into an agreement to have a way of defining what an asset is. So at any point in time where I feel that a particular element is an asset, then I would have to judge the element against the definition of the agreed and acceptable definition of an asset. Then I will assess whether it is indeed an asset or not. So if it's not an asset based on the set definition, then I don't want to recognize it as an asset. So that's basically what a conceptual framework means, and that's basically what the IASB conceptual framework means. Let's take a look at what the IASB conceptual framework means. Before we look at the IASB conceptual framework, I'm just taking a deep dive to really understand when we talk about the IASB. Because sometimes it's a bit confusing. You say IASB and you look as if we are imagining Europe. No. IASB is just a board of human beings, and these are experts in the finance and audit and assurance space. The board is geographically diversified. So there's an African on the board, we have Europeans on the board, we have Asians on the board. But it's just the IASB, one of the IASB spaces. So this is just IASB. As simple as that. Let me look for the African. It's European African. But this the IASB when we're meeting with some of their technical meetings. Right, so IASB is just what a board of human beings, and it coordinates the development of international financial reporting standard. They oversee the setting of international financial reporting standard. The conceptual framework is made up of one, the objectives of general purpose financial reporting, two, qualitative characteristics of useful financial information, three, financial statements, and a reporting entity, four, which is one of the most important components here, the element of the financial statement, five, recognitions and de-recognition. Six, we look at measurement, seven is presentation and disclosures. We look at the concept of capital and capital maintenance. Usually, FR will not assess it, so would even be silent on it. Now, from 1 to 7, we would highlight these components. The structures and purpose of the conceptual framework. There has been a lot of times where the ICAG has examined it, right? So the conceptual framework of financial reporting describes the objective of and the concept for general purpose financial reporting. So you realize that the financial statement that we'll be preparing in the exams is what we term as general purpose financial statement. General purpose financial statement means that when we prepare the financial statement, we do not have a unique user or a primary user in mind when we prepare the financial statement. We don't prepare the financial statement for only the consumption of shareholders, or for only the consumption of employees, or for only the consumption of management, creditors, regulatory bodies. No, we prepare it for the general consumption of all these stakeholders. Even though it might serve the purpose of some stakeholders better, the focus is for a general consumption. And that is how the IASB standards, right, help us to prepare those general purpose financial statements. There are some industries that require specific industry level reporting. When you take the mining sector, I don't know whether any of us work in the mine. If any of us works in the mine, can I suggest a thumb up or a reaction? Or if you work in the insurance company, okay, that's fine. When it comes to the mining sector, there is a kind of reporting that is relevant to mining, and it's called all-in sustaining cost reporting, right? and they would want to, after they have prepared their financial statements per IFRS, they also want to do their reporting in line with the World Gold Council's reporting framework. The World Gold Council's reporting framework helps them to prepare a kind of financial statement that helps them to determine what we call all-in sustaining costs, right? So we realize that the International Financial Reporting Standard, the IFRSs, its focus is on a broad consumption, right? So it's not also industry specific. That's what you are supposed to know. If you develop your career to a certain height, you might be required to learn an industry specific reporting based on the industry's regulators, right? So a single example is what I've shared with you. If you are curious enough, you can search on the World Gold Council. They regulate mining companies reporting, right? But the purpose of consultant framework and the IFRS is for general purpose financial reporting. The purpose of the consultant framework is to, one, assist the IAS to develop IFRS standard. So to develop IFRS standard based on consistent concepts. Then two, assist preparers, we are the preparers, to develop what consistent accounting policies when no standard applies to a particular transaction or other event, or when the standard allows a choice of an accounting policy. Then three, this is our focus. Assist all parties to understand and interpret the standards. So if you are here and you want to understand any accounting standards, we've been teaching FR for the past 50 years, and we know the rigid structure of teaching FR such a way that the students will automatically excel when they write their FR. So please, if you have learned FR in some way, in some structure, if there's some set of expectations, please, you can unlearn those ones now and at least try and follow wholeheartedly. So the best way for you to actually understand any accounting standard is to what? Understand the conceptual framework, and the ISB has clearly stated it in its purpose. So as your whole understanding and part of the FR is based on your understanding of the conceptual framework, and that's why I'm here for you. The status of the conceptual framework. The conceptual framework is not a standard. It is not in itself a standard. It is a structure or a framework that will be based on to develop a standard. But in itself, it's not a standard. So at any point in time where the conceptual framework conflicts with the standard will override the conceptual framework. As I said, nothing in the conceptual framework will override what? Any standard. Nothing in the conceptual framework will override any standard, even though the conceptual framework is the blueprint for developing an accounting standard. Okay, so let's get the various components of the IASB's conceptual framework. Like we've seen, the objectives of the inner purpose financial statement is to provide is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making economic decisions. So this one, so making economic decisions and providing what financial information. Basically, so the purpose of general purpose financial reporting is for financial information and decision. Those are the key points of the definition. When we talk about financial information, you are looking at what assets and liabilities. So that's economic resource. You're also looking at the changes in this economic resource, right? So assets and liabilities are economic resource. The changes in them. And so we look at what we usually assess with the profit and loss account. Assets and liabilities are key concepts, right? In themselves, these are the most important concepts that you can know. But assets and liabilities, you're able to define equity. Then, due to the changes in assets, and case liability, we're able to define what profit and what loss. So assets and liability are paramount what concepts that we would have what master. Okay. Decision making, because we said the objective of general purpose financial reporting is financial information and decision making. Whenever decision making, you are looking at taking economic what decisions. Either you are buying, you are selling, or owning equity or debt instrument. You are exercising your voting rights. You would want to probably stay in employment because you think that the company's financial statement looks good and it provides some kind of guarantee for going concern. And so that's an economic decision that users can take. For general purpose financial reporting, the concept that underpins general purpose financial reporting is what we term as the accrual concept. So this looks IFRS that we'll be looking at from IAS 16, IAS 20, IAS 23, 40, 41, all these accounting standards. The inherent in this accounting standard is what we term as what the accrual concept, right? It means that accrual accounting depicts the effect of transaction and other events and circumstances when the transaction takes place and not when what cash move. So we record transaction when the economic activity has taken place, not when cash is received, right? So if I sell goods to you now and you pay in the future, the economic activity of the sale has taken place, so the transaction can be recorded. That's basically the accrual concept. So almost all the accounting standard in the IFRS are based on the accrual concept and not what the cash reporting concept. The next component that we want to look at is qualitative characteristics of useful financial information. Right, qualitative characteristics of financial information. So we've looked at decision making. We know that for a general purpose financial statement, there are two objectives for decision making and financial information. But for the financial information, should be what? Should be useful, right? It should be useful. And for a financial statement to be useful, it should have certain what? Qualitative characteristics. Right? It should have certain qualitative characteristics. And there are two groups of qualitative characteristics. The first one is the fundamental qualitative characteristics, and the second one is the enhancing qualitative characteristics. The definition of these concepts is very simple. There was a time where I had an interaction with one ICAG examiner. Said, if you know the definition of concept, you realize that your answers are short. And if you are trying to write words in order to fill a page, where the answers are very voluminous. When you know the definition of fundamental qualitative characteristics, it's just 2 lines if you are done explaining. Fundamental qualitative characteristics looks at the content of the financial statement, and then the enhancing qualitative characteristics looks at what the presentation. That's the definition. So if you don't get the definition this way, you realize that it becomes difficult trying to explain it. So on the next slide, we have the definition. So fundamental qualitative characteristics looks at the content, and we have 2: relevance and representation. Enhancing looks at verifiability, comparability, timeliness, and understandability. And these concepts have been examined several times in the ICAG's exams. Last 2 years, ICAG examined it. Because it's very key when it comes to, because if the young professional is not trained to generate relevant financial information now in the space of AI and big data and data analytics, right? If you're not able to provide relevant or useful financial information, it becomes difficult to make any sound economic decision. Relevance looks at whether the item that we are reporting on is important or not, right? And it's important when it's able to affect the decisions of users. The materiality is a threshold concept, right? It's a threshold. That means it's a concept that can fall under fundamental qualitative characteristics. Those are concepts that can fall under enhancing quantitative characteristics. And because it is entity specific, right? Materiality is entity specific. It's just in this phase. What can be material to one company is immaterial to another company. When you take a huge, let's say, oil and gas company, $50,000 might be one petty cash expense, whereas for other businesses, $3,000 is not a petty cash expense. It is their whole business as the personal resource of the owner. So, actually, is a threshold concept. One thing that I want to bring your attention to is when you define materiality, we are looking at both this concept, nature and what? Magnitude, right? Nature and magnitude. It's one concept that auditors usually like. Because the nature of an item can make it material, even though it is, in terms of currency term, it is small. But by its nature, it can be material. When you take in audit, when they look at fraud, by fraud, we don't have to wait for it to be $100 million for us to say it's significant. By its nature, if the transaction is fraudulent, by nature, it's material. So materiality looks at what can be assessed based on what, even though it's entity specific, we can assess it based on nature and what and currency magnitude. Please take note. Faithful representation means that when you are preparing the financial information, be complete and free from any what clerical error. Comparability, the structure of the financial information should be kept the same over some reasonable period so that it can aid in easy comparison. So we don't change accounting policies year on year. At any point in time where we want to change accounting policies, we'll have to probably provide a justification as to why we're thinking that the new policy is more relevant than the existing one that we are changing from. Verifiability, when we prepare the financial statement, it should be very easy for everyone to verify. So because of that, we don't bulk figures together. When you pick any financial statement of any business, when you go to the stock exchange, the financial statement of any business in the stock exchange, you realize that there might be figures, right? There might be figures that you can pick your calculator and try and tabulate and confirm or otherwise. So when we prepare our financial statement, it should be such that financial information on the financial report should easily be verifiable. Timeliness. We are supposed to provide financial information in a timely manner. Understandability. These are concepts that I think we are very familiar with. So the objective of the financial statement that you'll be preparing in your ICAG exams is to provide financial information about the reporting entities' assets, liabilities, equity, income, expenses that is useful to users of financial statements in assessing the prospects for future net cash inflows to the reporting entity and assessing management stewardship of the entity's economic resources. At any point in time where we assume accrual concept, it means that we are also assuming what going concern, right? It cannot be accrual if there's no what going concern. Reporting entity. So reporting entity is the entity that prepares the financial statement. And in our case, a reporting entity can be a subsidiary, it can be an associate, a reporting entity can be a department, right? So let's take note. Or an operating segment. Well, a reporting entity is the parent. The financial statement that they will prepare is what we term as what the consolidated financial statement, and the parent only. That financial statement is what we term as the single entity financial statement or the unconsolidated financial statement. if there are two if there are two companies, right, that are not in any parent subsidiary relationship, and if you are supposed to prepare an account together, that account is what we term as what combined financial statement. So with consolidated, we prepare it for two entities that have a parent subsidiary relationship. We look at it later in our course, but at least to get to know that when we talk about consolidated financial statement, we are looking at two entities that have the parent and subsidiary relationship. The financial statement of one entity alone is what we term as the unconsolidated financial statement. But if you have two entities that are not linked together, for instance, you don't own any share in business. I also don't own any share in your business. But we decided to go in for loan together. And because of that, we are supposed to prepare or combine our financial statement or put our financial statement together. That process of putting our financial statement together in order to go for a syndicated loan is termed as combined financial statement and not a consolidated what financial statement. The most important guys of the conceptual framework, the element of the financial statement. I guess being here, at least we know or we've heard about assets, liabilities, equity, income, and expenses, right? I would want to know, can anyone assist us with, in their way or based on their prior knowledge, how an asset is defined?
Please, can you repeat the question again?
How do you think an asset is defined, or based on your prior experience or knowledge or education? If you come into contact with the definition of an asset, how has asset been defined based on your past experience and education?
Okay, sir. Assets can be defined as the resources owned and
Can you
controlled.
speak up a bit?
All right, so asset is defined as the resources owned and controlled by an entity from which future economic benefits are expected to flow to the entity.
Fantastic, fantastic. When we hear resources and we hear control, it puts our heart to ease, right? But from previous explanation, we have defined asset as ownership, right? But the IAS conditional framework just as John explained. Thank you very much. Right, so another is a present economic resource control. Right, so we are looking at present economic resource, right? Even though we focus on economic resource, this word here is very paramount. So if it is a future economic resource, then it doesn't qualify to be what? To be an asset. But what we are looking for is a present, right? Economic resource. So that's what we should take note of. So it is present now. It's an economic resource that we have now, and it's under our control, and it's because of what past was event, right? As other economic resources will flow, you hold on that. But sometimes some of the assets might have potential to produce economic benefit, but that is not the basis for treating it as an asset. What we want to look at is it a present economic resource now, and do we control it? There was a time, I think somewhere 2018, 2019, when the ICAG was examining FR, he asked whether those antiques, right, and those drawings, paintings, right, the castle paintings, whether it was an asset. What do you think? Yes, those Picasso paintings. In your view, do you think it's an asset?
I'm not getting the painting.
So, MC, art, work of art, right? Work of art. When you go to art gallery, those paintings that are displayed in art galleries. In your view, do you think it's an asset?
Yes.
Okay.
So it's an asset because it's an
We can
economic resource.
Okay.
And it has the potential to produce economic
classify them
benefits.
as an asset.
Hello.
Okay. And how does it produce economic benefits?
Please.
It produces economic benefit in terms of the tourists who will come and make a payment to either view or to call for reproduction of that drawing.
Okay, perfect.
Say,
All right, thank you. That's perfect. So if you have met such a question, hello, Jem.
Yeah, it depends because it depends on the kind of business they are performing. Because let's for instance, there is these huge pictures in most of the banking halls. I don't think they will be classified as assets. Like for instance, Bank of Ghana, for instance, there are some very nice artworks there, but they don't bring tourist income. They don't generate income from Bank of Ghana. But if, like, let's say a business producing artwork, yes, then it can be classified as an asset.
Also, for Bank of Ghana, those huge paintings, if Bank of Ghana is recording its assets, Bank of Ghana recorded as part of its assets.
No.
No.
Yes.
No,
They will
sir.
not
Okay, that
record.
means when we incur those costs, we are supposed to expense it. Yeah, Evans, please
Yes.
join in the
Coming
conversation.
from it.
Yeah, Godwin.
So, please, I think for the paintings or for the monuments in Bank of Ghana, it depends. So we have a capitalization policy. If the value of those monuments are above the capitalization policy in Bank of Ghana's accounting policy, that if anything that has been bought and is a potential asset, that is, let's say 5,000 and above, it should be capitalized as a fixed asset or it should be part of the building, then yes, they will be capitalized. But if it is lower than that, then it will be expensed. I think it just depends on the company's policies.
So, Evans, that's fantastic. But the focus is not on measurement and recognition. When you go to measurement and recognition, that's different. But the focus is does it as a definition of an asset? Then we want whether we should recognize it. Right? So is now bringing it to the book, and companies will set a recognition criteria, right? Or capitalization criteria. But in itself, it is an asset that needs to be recognized. Godwin. Evans, you can unmute and let me hear your view.
In itself, if it's not generating any wealth for the company, then it should not be recognized.
Come again.
In itself, if it is not generating any wealth for the company or it's not generating any intrinsic value for the company, then it should not be recognized.
Please, let's hear you.
Yeah, please, I also think if it is not an economic resource, because the economic resource has the potential to generate economic benefit. So if it is, though it is in the business or it is hanging in the business, it can't be classified as an asset.
Okay, let me answer this question. This building, right? Does the building in itself has a potential to produce economic benefit?
Yes,
or the AC in an office, does it have the potential of generating economic benefit?
No, but then it is contributing to producing a good working environment.
So good working environment also when assets help to contribute to producing good working environment. For that, in that case, that the building is an economic asset, right? Is that what they're saying?
Yes, please.
But what if you have the nice pictures and it creates that relaxing environment? Don't you think it serves the same purpose?
Yeah, literally. Yeah.
Yes, it does.
Okay, interesting. Yeah, Evans, please tell me then.
So that is what I was talking about. That so it depends. So you see that the building, those pictures in this case could be providing value that you don't necessarily see or you don't necessarily attribute to the key factors that provide revenue for the company. But so far as it's part of the company, and then so far as they are being displayed as assets for the company, then up to a point, you can capitalize them or they provide value to the company.
No, so Evans, I get your point. But I just want us to move away from the issue of capitalization or not capital. That issue is recognition components. I just want us to see it as an asset first before we look at capitalizing or not capitalizing.
Okay. They are assets for the company up to a point. They are
Okay.
not fully, but up to a point.
Please come in.
So they are assets for the company. They might not provide direct value.
Yes, so we want to end the conversation there. With an asset, because then we'll look at whether to recognize it or not. So the recognition, the setting of the capitalization threshold is materiality that is entity specific, right? To one entity, they might recognize those huge drawings and paintings as part of their asset because the value of that painting and drawings is significant. For other entities, it's going straight into stationaries, right? So we don't want us to look at the recognition because it will bring into discussion materiality, right? Which we know it is entity specific. But by its nature, we realize that those old paintings or those nice paintings, depending on its value, it can be recognized as an asset for an entity, depending on the part of the case. And in most cases, if you are defining an asset, you are looking at one present economic resource. So the present is important. When it's going to create a future economic resource, we don't create it, we don't recognize an asset. So future economic resource is not recognized, but rather a present economic resource. And we have to check whether the entity has control over that economic resource. So at this section, we are looking at discussing right, potential to produce economic benefits, and control. So these are the three components that we would want to use in assessing whether an item is an asset. So right, that's the first one. We look at potential to produce economic. So the potential, right? The potential is it can be possible that it doesn't produce economic benefit, but it has the potential to do so. Then you have the control. Let's quickly wrap up this section. So, right, that's our potential to produce economic benefits can take two main forms, right? It can take two main forms. There are those rights that does not lead to. There are two types of rights. We have financial rights and non-financial rights. Usually for financial rights, when you have the right, it means that there's a counterparty that has the obligation. So for instance, if someone owes you money, that person becomes your receivable. So they are obligated to pay. Now you have the right to receive money from that person. So this right is leading to a counterparty obligation, right? Then there's the right that does not have any counterparty obligation. Example, when you own, let's say, a phone, the fact that I own this phone does not mean that someone owes me money, right? If I have my phone, my office plant, my office equipment, my AC, my building, those rights is right in a tangible asset, and it does not lead to an obligation in account by a counterparty. So usually those rights or asset rights that leads to counterparty obligation are usually termed as financial assets. But so those rights that leads to a counterparty obligation are usually termed as financial assets. And those rights that does not lead to a counterparty obligation are the normal assets like the IAS system, property, plants and equipment, intangible assets. So we realize that trying as much as possible to appreciate the governmental framework, we realize that we made mention of concepts like financial assets. So it means that when we are looking at a concept, a standard like IFRS, financial instrument, it becomes easier for us to appreciate what financial assets, because those financial assets is resulting in an obligation in another counterparty. Okay. Uh-huh. This one was I want us to look at. Very important. So for that potential to exist, it does not need to be certain or even likely that the right will produce economic benefit. I'm not be looking at what certainty or likelihood, right? I'm not looking at certainty or likelihood for a potential to produce economic benefit. We don't even want to assess whether it is certain. That is why in the new IAS framework, in the definition of assets, they will want to drop this potential to produce economic benefit. Control is the third component of defining an asset, and it is from the definition of this control that we get the definition for a subsidiary. Right. And it is this definition of control is the same definition when you're looking at IFRS 3 and IFRS 10. Right, the same definition. When you look at IFRS 3, IFRS 3 is a business combination, and IFRS 10 is consolidated account. The definition of control in this standard is the same definition here. Right, so control links an economic resources to an entity. Basically, that's the concept of control. Let's at the concept of control. Very good. So control. Control includes the present ability to prevent other parties from directing the use of the economic resource or from obtaining the economic benefit that may flow from it. The ability to prevent is very important. In the street light, if there's a street light in front of your office, you can't claim that street light is your asset. If there's a road in front of your building, or in front of your house or your office, you can't claim that road is your asset, because you cannot prevent other people from using that road, right? No road in itself is an asset. It can be an asset for the government, but for a business, you can't control. Even if you construct that road and you help rehabilitate that road, you cannot prevent other people from using those roads. And we on to the next concept, liability. Liability is a present obligation. The keywords here are very important. The present obligation. And for us, it is present economic resource. When it is a future obligation, then when it's a future obligation, you realize that it becomes a contingent liability. Becomes a contingent liability. Okay. Then also, it is obligation of an entity to transfer economic resource. Not just any obligation, an obligation that affects the transfer of economic resource. Basically, that's it for a liability. So the key word here is present obligation. We can just single out obligation and define what obligation. So the three criteria for defining a liability might be satisfied. That's the obligation. And that obligation in future or now will lead to the transfer of economic resources. Basically, that's it. It is for this definition that we can define what a provision. Okay. And we have two types of obligation. We have a legal obligation and we have the constructive obligation. So that's it. So we have a legal obligation and we have the constructive obligation. The legal obligation is by law. By law, the provisions of an agreement, right, has placed an obligation on us. If I tell you that, okay, give me your goods and I'll pay in the future, and we enter into this contract. So based on this contract, I bound myself that in future I will pay a certain amount. So now I owe you in future. So I owe you now. So it's a present obligation now. And that's a legal obligation. Legal obligation comes from contract, right? Simple contract. That's all. Then constructive obligation comes from past practices. It comes from your policy. It comes from actions that you've taken in the past over a long time. It comes from an industry practice. And because of that, you raise a valid expectation in the other party such that the other party is expecting you to perform. For example, when you take those that are working in the extractive sectors, mining and other extractive sectors, you realize that there might be some form of social responsibility activities or initiative that a company will be undertaking. And for a very long time, the company, aside their legal rehabilitation, might be paying for scholarships. Scholarship is not in any law that companies who are in the extractive sector are supposed to pay for scholarship. But based on your past practice, you've met with the community chief and you've established a scholarship scheme where you pay the scholarship for people in the community, and you've done this for 5 years. You realize that in the automatically there's valid expectation that you are supposed to do it. So the community might expect this from the company. So the company can treat it as a form of what? A liability. Okay. The transfer of economic benefits might lead to obligation to pay cash or deliver goods or provide services or issue financial instruments. Basically, that's it. And when it is to deliver cash or financial instruments, those obligations are usually what? Financial liabilities. Right? Those obligations are financial liabilities as defined in IFRS 9. We'll be looking at those standards later. At least to let you know that because of the project, we need to really appreciate some of these standards before time. Equity is the residual of assets and liabilities. When you take income is usually as the increase in assets, one, decrease in liabilities, right? And it excludes money that is coming in as a result of what? Equity participation. So revenue is from main business, whilst gains is from auxiliary. Expenses, decrease in assets, increase in liabilities. Basically, that's all. Except for distribution to equity participants. So once you are distributing to equity participants, we can't call it expense. You have to call it what? Dividend. Yes, we have to call it dividend. When it comes to recognition is the process of capturing an element into what? Into the books. Right? So recognition is the process of capturing an element into the books. So once we say that an item is an asset and we pass double entry, recognition is simply passing double entry to bring an item into the books. And recognition is the opposite, right? It's the opposite when we are writing an element from the books. So the only way, so this is what I tell my students. Let's see. Let me highlight this for you. So you see, recognition is the process of capturing or inclusion in a financial statement or financial position an item that meets That means the definition of that element, right? So if you want to recognize an asset, then that item that we are calling an asset, income or expenses, then they should meet their definition by the quantitative framework before we can recognize them. So recognition is subsequent to the item meeting its definition. So if it fails to meet its definition, then it ceases to be recognized. But at any point in time where an item ceases to meet its definition, then it will be recognized. So we can recognize it at inception. We can recognize it as an what? As an asset, as an equity, income, liability, or expense. But in future, it might be possible that they might lose their definition. Hence, we would have to be recognized. So the amount at which an asset, a liability, or equity is recognized in the financial statement is called what? Carrying amount, not carrying value. Carrying amount. So let's know the degree is very important. It's not carrying value, it's carrying amount. But then value can have other meaning. Then we look at the recognition. So the recognition is when the item or element has lost its definition. So we don't want to see it as an asset or as a liability or as an equity, income or expense. So we are de-recognizing it. Example: when you have a plant, right? When you have a plant, based on the definition of an asset, the plant should be a present economic resource, right? That's based on past events. Probably you purchased, you hired it, you leased it, to give you economic benefits. If you have a plant and the plant is damaged, right? Damaged beyond repair. If the plant is damaged beyond repair, the question is, does it still meet the definition of an asset?
No.
No. If it doesn't meet the definition of an asset, what do? We would have to de-recognize it because now the plant has lost its definition of being an asset. So we have to de-recognize it. De-recognize is simply the process of what? Removing the elements from the books of accounts. Basically, that's it. Then we move on to the next concept, which is measurement. For you to do recognition, you need to what? Be able to measure. And there are two ways of doing measurement, either the historical cost or the current value. With the current value, with the historical cost, we are looking at the cost that we manufactured or the cost that we acquired the element, right? Then with the current value, we can either look at the fair value. The fair value is the amount of money that's exchanged between two parties in an arm's length transaction. Then we can look at the value in use. Value in use is the present value of the future economic benefits discounted to the now from the usage of the assets. Current cost is usually how much we can incur to replace the value of an asset. So these are all ways of trying to put value on the right element, right? We can either use the historical cost, we can either use the current cost. There are some instances where we use the historical cost. An accounting standard like IAS 16 use the historical cost. When we are doing consolidated accounts, right? Those who have an idea of consolidated accounts, our work is true. Our work is true. We look at the fair value of the what? Net assets of the subsidiary. Right. So for group accounts, when I do the consolidation, we use what? Fair value. There are some instances where we can use fair value. When we take IFRS 9, when we take IFRS 9, if you're looking at some financial assets, you can measure some financial assets as fair value through other comprehensive income and fair value through NL. Right. So realize that in some accounting standards we use fair value measurement, right? Okay. Presentation is how we disclose the transaction on the face of the financial statement by virtue of us communicating it to relevant users. All right, so that brings us to the end of an interesting conceptual framework discussion. Any questions so far? Okay. Yes, Oti, please ask the question. So in this class, if you have any question, please feel free. And I might not see the hands, so please feel free. Just unmute and interject. Oti, please answer. Ask your question.
Okay, so my question is with the fundamental, pardon, under the qualitative characteristics. Yeah, I saw in a certain book that.
Come again.
Okay, my question is this one, the qualitative characteristics of the qualitative characteristics of financial information.
Yeah, so
I saw in a certain book that you see we have the fundamental one. Okay, my question is like in a certain book I saw like three. They gave me three this one qualities under the fundamentals. But you see, what I know is the relevance and the faithful representation. But with that one, they added materiality as part of
the other those.
this one there. So I was asking whether is it like acceptable or we should maintain the two. Or...
Okay, so this is an important question. But
Like in case you
which
have
book did you see?
asked, maybe stay there this one, the fundamental
Okay.
this one, qualitative.
Okay, but which book did you see? You did see this?
Some accounting. Okay.
Yes, so, yes,
I will
that's
take
fantastic.
a picture
So
of it and
we read that OT,
I don't
what
have
we are
it right
doing,
now.
we are looking,
I saw it
we are
in
looking at
school.
the definitions
A
from
textbook
the
we
conceptual
use.
framework and not an accounting book, right? So perhaps it's possible that the author might be stressing on the concept, but the IASB's conceptual framework, this components that we looked at, all these accounting standards that I present on this slide are coming from the what IASB document. So in the IASB documents, they only recognize what two fundamental qualitative characteristics, which is what you rightly said, relevance and faithful representation. But they still mention that there is the threshold concept, materiality. But for them, it's only relevance and faithful representation that are the two fundamental qualitative characteristics. There's a lot to even talk about this qualitative characteristics of financial information because there is some element of trade-off. Because if you want faithful representation, right? If you want faithful representation, then you have to you might trade off what timeliness. If you want everything to be 100% accurate, right, or about let's say 99.9% accurate, then you might be trading off what relevant, or might be trading off what timeliness. So there are trade-off among the special qualitative characteristics that we describe, but I didn't even mention them. So if you want to make any reference, if you are learning and want to make any reference, please try as much as possible to use on the Google Classroom. I will upload some of the abridged IFRSs for you so that you can use that as a form of reference, in as much as we might consult local textbooks for questions and attempting questions. I would want you to always go to the source. It's just like law. If you have any questions in law, you don't use an interpretation in an exercise book, in a textbook, sorry, but you always have to make reference to that particular statutory act. So that's an important question, Oti. Right.
Hello,
Okay.
Bernard.
So
I'm
Trey,
trying
ask your
to.
question, then you can ask after that. Gideon.
Yeah, so can you hear me? Hello, hello, hello.
Gideon, please ask your question.
Yeah, please can you hear me? Hello,
Please,
please
can you
can you
speak
hear
up
me?
a bit?
Yeah, can you hear me? Can you hear me?
Gideon, we
Yeah,
can
not
hear
really
you,
audible.
please.
Okay.
Okay, okay. So I wanted to ask, you see,
Okay.
with the due recognition, you made mention of it being a removal of an asset or liability of an entity statement from an entity statement in the financial position. So let's take something like a motor vehicle that is generating income for the company, or the company uses it to run their daily business. And then they use it from, let's say, January to July. And after July, it gets faulty and it cannot be fixed. It's false completely. So with that one, how are we going to treat it? Are we going to consider it as being, are we, will we remove it from our financial statement totally, or will calculate the number of months it worked for us before it got spoiled? Yeah, that's what I want to understand. I'm done.
Gideon, sorry,
Okay.
my network was terrible. I struggled to hear you. Can you please repeat the question?
All right. Can you hear me now?
Yes, yes.
Okay. So I said with the due recognition,
Mm-hmm.
you said is the removal of an asset or liability from an entity statement or financial
Okay.
position. Then I'm asking, let's say we have a motor vehicle that generates income for the company, or we use it to run our day-to-day activities. And then in the year, that financial year, it got spoiled from, we used it from January to July, and it got spoiled. So we used it for 7 months, and it got spoiled, yeah, completely. If we are preparing our financial statements, definitely we will calculate the months that it worked for us, as in from January to July, or we wouldn't add it. Since we are saying we will remove it from our financial statement, we wouldn't add the number of months it worked for us before getting 40. Yeah.
Okay, that's fine. So the question is simple. The answer is simple. We do degree recognition on the date the asset, the element loses its definition. It's as simple as that. So if you've been using an asset from January to July, it's an asset. So if you're even if you're doing monthly reporting or quarterly reporting, you would have recorded it as part of your quarter asset, because it's an asset. It was an asset as at that time, or it met the definition of an asset as at that time. But in July, it ceases to be an asset. So we do derecognition on the date that the asset ceases to become an asset. If there's any depreciation and any other economic nominal impact, they still remain. So because we're using the asset from January to July, any income, it's income. You don't derecognize the income because it's income that have been earned. If there's any depreciation, you would have recognized depreciation. But at the point where the asset ceases to become an asset or the element ceases to become an element, you do recognize it.
Okay. All right. Thanks.
You're welcome. So I don't think it's an issue. Coming that's your question. Let's continue, please.
Seven, I wanted to try to see if I can recap what we have done on the conceptual framework.
Mm-hmm.
So you started by teaching us the general purpose financial statement. And That is where you give us the importance of the financial statement. Then the qualitative financial statement, you said that is relevance and fair representation as the main financial statement. And you give us understandability, reliability, verifiability as the enhancing characteristics of the financial statement. I remember you added timeliness too. Then you give us the reporting entity. Under the reporting entity, you said that when we are reporting for our entity, a parent and a subsidiary, it is called consolidated financial statement. And when you are reporting for that parent only, it's unconsolidated financial statement. And then when we are reporting for entities that are similar but not the same, we can call it combined financial statement. Say, am I correct?
Some of them they are correct. Some of that I didn't see it that way. So, but it's a beautiful way of trying to recap, and at least some students learn that way. Recapping whatever I've been taught and getting feedback from it. It's a beautiful way of learning. Kobina, thank you. So the qualitative characteristics financial statements, there are two. We have fundamental and enhancing. And the fundamental, I define it as those qualitative characteristics that looks at the content of the financial statement. Then enhancing looks at the presentation. It has come before, where the ICAG asks the student to define fundamental qualitative characteristics and enhancing. And the definitions are very simple. Fundamental looks at the content. Enhancing looks at the presentation. Yes, okay. So I think that's what I would just want to add.
Okay.
Right. I think the participation level has been pretty impressive. I think that's the only way we can actually get the most out of this class. Most of the time when I start on introducing the accounting standard, I start with IAS 8. Every accounting standard that you ever see it is based on IAS 8, or it is contingent on IAS 8. So I want to teach IAS 8 as one of my first accounting standards. IAS 8 is simply accounting policies, changes in accounting estimates, and errors. Right. So the objective of this standard is to prescribe the criteria for selecting and changing accounting policies together with the accounting treatment and disclosure of changes in accounting policies, changes in accounting estimates, and correction of errors. I'll share the slide with you, so don't worry. But if you are supposed to make your personal notes, feel free and make those notes. Those notes are your life-saving notes, so please make them. With a school, this standard shall be applied in selecting and applying accounting policies and accounting for changes in accounting policies, changes in accounting estimates, and correcting prior periods error. Okay, so let's talk about the definition. So accounting policies, they are the specific principles, basis, convention, rules, practices applied by an entity in preparing and presenting financial statements. So a policy is a specific principle or rule. So if, let's say, when you take an asset and the accounting standard is giving you two principles, let's say IAS 16, when you take the subsequent recognition of an asset, right, it says that at inception, you recognize an asset at cost, but subsequently or after that, the standard gives you two options, either to use the cost model or the revaluation model, right? So the standard has given you to use either the cost model or the revaluation model. When the entity decides to use the cost model, that becomes what? A policy. When they decide to use the evaluation model, then it becomes what? A policy. So the specific principle that the entity chooses becomes what? A policy. Okay. So let's note it. Okay. A change in accounting estimate. I don't let me just define accounting estimate. Estimates are reasonable consumptions, reasonable assumptions that a business would use, or most businesses use, in order to come up with an economic term or an economic value, an economic transaction. And those estimates are sometimes based on the current available data that the entity might have. So if, let's say, I have an asset, I have a car, or I have a plant, no one for sure can determine or be able to determine the specific useful life of that vehicle, or how that vehicle will be consumed. In most cases, there can be technical estimates. So those who manufacture the car can say, okay, this car, looking at the axle, looking at the chassis, the tire, the what, the car is likely to last for, let's say, 100,000 miles. There are some cars that, based on the manufacturer's design, those cars should be its useful life is way past. But believe me, tell you, that car will spend 5 years in Abuja, come to Ghana, and we can use that car for 20 years or 30 years. So you realize that useful life is just based on what? It's based on what? Estimation, right? So let's take note of it. There are two ways of accounting for a change. There are two ways of accounting for a change. If you have a policy, if you have an estimate, you are correcting an error. There are two ways of accounting for a change. When you take IAS 8, we have retrospective restatement and prospective restatement. Retrospective restatement means that.
Sir.
Yes, Ernest.
Can you please explain the changes in accounting estimate again? Sorry.
No. I didn't explain changes in accounting estimate. I'm just looking at estimate. So estimate in it form. Realize that I didn't even talk about changes in policy. So I only try as much as possible to explain policies and realize that estimate here is rather a change in accounting estimate. So I just want to focus on just the estimate. So an estimate is because we are using assumptions, right? It can be a budget, it can be an exchange rate estimate, it can be a consumption estimate. So for instance, if you have that, I was using the non-current assets as an example, the way the assets will be used, right, either on a straight line basis or reducing balance basis, that depreciation method, right, is not an accounting policy. That's what you should know. The depreciation method, it is actually an estimate, right? The valuation of the asset, whether cost model or revaluation model, is a policy. But whether straight line, reducing balance, some of the years did it is just an estimated way. Yes, it's an estimated way of thinking about how the assets will be utilized. If, for instance, we say that in future, after 5 years, after using this asset, it will have a value of what? 4,000. That 4,000 that we project is an estimate. We don't know for sure, right, whether after the 4 years or after the useful life, the asset will have what? That scrap value. But we try as much as possible to put some figures together, try and do some discounting. So estimate is not just arbitrary conjecture, but there is some kind of scientific approach. If I'm doing some kind of a discount NST.
Okay, I understand.
Okay.
So let's say
then later on,
let's say something like making a provision for deferred tax.
Exactly, making a provision for a deferred tax.
Okay, I understand. Thank you.
You're welcome. So once I'm able to explain the types of accounting change, then I'll go back and look at what changes in accounting policy and changes in accounting estimate. So with retrospective restatement and prospective restatement are the two main types of what accounting change that we can have. What about retrospective restatement? It means that we want to go back as far as possible, right, to effect the change as if the prior period event never occurred. Then for prospective change, we will change today and move on. So it is today and into the future. For retrospective, we go back into the past and try and treat the transaction as if the old treatment never occurred. But in reality, there's no way anybody can go into the past, right? There's no way anybody can go into the past. And there's some amount of constraint on any business if they want to go back into the past and effect an accounting change. So you realize that there are two financial statements. Basically, there are two financial statements. We have the balance sheet and we have the P&L, right? The balance sheet is usually headed assets because with balance sheet it looks like economic resources, right? And claims. So with balance sheet it has assets, liabilities, and what equity. And it is assets. It is on a cumulative what basis. But the P&L or the income statement is headed for the year or for the period. So it means that for P&L items, we don't aggregate or we don't accumulate. So for example, if we have sales for 2025, when you're looking at 2026 sales, we don't add the 2026 sales to 2025. We treat each nominal transaction in its block year. We treat in its block year. I hope you are all following. But the result of each nominal transaction treated in the profit and loss account is translated into what we call the retained earnings. I hope we are all clear with that. Who here doesn't understand what I've just explained? When you look at the P&L for last 3 years, the result of it will either be a net profit or a net loss, right? P&L for last 2 years will either be a net profit or loss. For last year, it's either profit or loss in that order. So you realize that all those net profit, net loss, net profit, net loss is aggregated into the retained earnings, and it's sits on the balance sheet as well as equity. Okay. So at any point in time where we are doing retrospective adjustment, and that retrospective adjustment affects a P&L item for prior periods, right? For prior period means that we've closed the year and we've transferred its nominal results into retained earnings. So for prior periods, if you are doing retrospective adjustment, you realize that for prior periods, the retrospective adjustment will hit, if it affects P&L, it will hit retained earnings. It will hit the opening retained earnings. When we do that, we say we've done what? Retrospective adjustment. But if the account that we are trying to do retrospective adjustment for is a balance sheet account, then we will charge it against that balance sheet account because it will have a balance. For nominal items, they don't have what? A balance on their own. Their balances is submerged in the retained earnings. So when we want to do retrospective adjustment, we can't go to the sales account for last 4 years and open it and affect the change. No, that sales, its result is in the retained earnings, opening retained earnings. So if you want to do retrospective adjustment, then we would have to affect, or we have to pass the double entry against the retained earnings account. But if the retained earnings is a balance sheet item, then it's easy. The balance sheet account is available, so you can just pass the double entry against it. That is the only difference when it's going to about retrospective adjustment and prospective adjustment. So for prospective adjustment, because we are in the current period, we would affect the change now, then move on. For retrospective, if it is balance sheet, we affect the balance sheet. For prospective, the balance sheet, we affect the balance sheet. But if for prospective, if it is P&L or balance sheet, or if it's P&L, we will treat it in the current year P&L, right? But for retrospective, if it is P&L, if the issue affected P&L, then we would have to affect the opening retained earnings. At what point in time should we do retrospective, and at what point in time should we do prospective? There are 3 types of change, or there are 3 types of what change that we have to account for. So if the event, if it is a prior period error, right? If it's a prior period error, we found an error in 2025, or you find an error in 2020, let's say 2024. It's a prior period error. Prior period error, you found it today. There's no way you can go back and what do affect your P&L. No. So that one you have to do retrospective what adjustment. For prior period error, we do retrospective adjustment. For current period error, you found the error in this month. You don't do retrospective, you do what? Prospective. That means you change it now and you move on. If it is change in accounting policy, right, that is mandatory. But that now there's a new IFRS coming to replace IAS 1. If the change in accounting policy is because an old accounting standard has been repealed and a new accounting standard is in force. Previously we had IAS 17, the leases, and now there's IFRS 16 for leases. So if you are changing from the old leases to the new leases, that is a prospective change. A change in accounting policy, that is voluntary. You are changing from the revaluation method to cost model or cost model revaluation. That one you have to treat it retrospectively. And change in accounting estimates is prospective change. So because of this guy here, change in estimate, we do prospective change. So we have to know the difference between what is an estimate and what is a policy. That was what I was trying to explain. Because for policy, we do retrospective, but for estimate, we do prospective. So if we start looking at IAS system, PPE, we are changing the depreciation estimate, whether from straight line to okay, I'll share learning materials with you. Now again with the treatment of accounting for change. Okay. This summary, I think this summary should help. If it is a prior period error, we'll do the change. We'll correct the change. We'll correct the change against retained earnings, opening retained earnings, and the balance sheet item. If it is a current period error, we will correct the error against P&L and balance sheet. Basically, I think that explains it. If it is accounting for policy, change in policy, which is mandatory, we will correct the change in current year P&L and balance sheet. If it is accounting for change in policy, that is voluntary, we will account for the change against opening retained earnings and balance sheet. If it is accounting for estimate, we would account for the change in current year P&L and balance sheet. Okay. Let me give you an example of the prior period error. So let's assume that, let me just bring my test box here. So you found out that 500K, right, cash was stolen in 2026. Right, you found out that 500K cash was stolen in 2026. You found it, and the cash, this cash, no, let me use this year. Let me use, okay, 2024, right? So you realize that if you had any cash if you had any cash, the cash would have been would have been overstated by 500,000, right? Please unmute and let's have a discussion.
Yes, please.
Good. So now that you found this error, will you go and take? You obviously have to credit your cash with 500,000, right? Because the error is affecting the balance sheet item. So you credit your cash with 500,000. Now you have to reduce your cash balance. Did you get it? Okay. With 500,000. Once you credit your cash balance with 500,000, there's a nominal impact, which is debit something, debit P&L, because you have to treat it like an expense or a loss. Do you get it? In things like loss, are we going to pass it? We found that this cash was stolen in 2024, but it came to our notice in 2026. The question is, are we going to treat it as an expense in 2026?
No, please.
Good. If you treat it as an expense in 2026, you realize that it's going to affect the performance of 2026 because the loss happened in 2024. Right. So if we want to do the debit will not hit this current year's P&L, but the debit will be charged against the opening retained earnings for this year. By virtue of debiting the opening retained earnings, we say we've done what? Retrospective adjustment. But if the debit hits this year's P&L, then we would have said we have done what? Prospective adjustment. So if the error or the cash that was stolen happened in 2026, we realize that we would credit the cash account with 500,000, then we debit what this year's P&L with 500,000, then that is what a prospective adjustment. The impact, if you type, I don't know, okay, I don't know where you are, but if you type in the chat, I might not see. Then I will analyze my screen, so I don't see some of the chats. Let's assume that Ebenezer is the manager of a company. He was employed this year. Ebenezer, you are a manager. You are employed this year, and you are told that your bonus is based on this year's P&L performance. Oh, okay, yeah, thumbs up, manager. Your bonus is based on this year's performance. You started January. You have positive results, right, with strong initiative. Then we are ending August. Then you find out that a syndicate in the company, right, stole 100 million Ghana cedis from 2020 to 2025. 100 million. Right, 100 million. Do you think that it would be fair if we charge this 100 million as an expense in this year's P&L when you have worked so hard?
No, please.
No.
You realize that it is significant, the treatment of the error, right, or the estimate of the policy is very significant. Whether we should treat it as retrospective adjustment or prospective adjustment is very significant. But if we charge this expense in this year's P&L, we realize that Ebenezer is going to suffer because he has worked so hard to earn the economic income for this year. So any impact, any prior period error should be charged against the retained earnings. For the retained earnings, he didn't contribute. The retained earnings is the cumulative result of prior periods of performance in the retained earnings. So this 100 million should be charged against what? The retained earnings. Right? The retained earnings can go into negative. So they can have negative retained earnings. That's possible. And that negative retained earnings can affect what? The stated capital. That's perfectly fine. So once we find out that there's a prior period error, the nominal impact hits retained earnings. But if there is a current year error, the nominal impact hits what? Current year's what? P&L. Okay. For policies, to the same thing. If we are doing a voluntary policy change, we do what? Retrospective. If it's mandatory policy change, we do what? A prospective change. Estimate is prospective. Okay. Who can help us in reading? I saw a message in the chat. Yes, the video will be uploaded on YouTube. What's your person reading, eh?
Okay. Question 1. The draft financial statement for an entity for the year ended 31st December 2007 have been prepared. A final review of the draft reveals an overvaluation of the closing inventory of CU 200,000 at 31st December 2006. Further investigation shows that there was an overvaluation at 31st December 2005 of 120,000 CU. According to IAS 8 accounting policies, changes in accounting estimates and errors, what adjustment should be made to the profit for the year ended 31st December 2006, presented as the comparative figure in the 2007 financial statement? A. 120,000 CU decrease. B. No change. C. 80,000 CU decrease. And then D. 200,000 CU decrease.
Okay, so yes, you can help us attempt this question. Where are we? We are currently at 31st December 20x7, right? So that's the current financial year, right? That's the current financial year. So the final review of the draft will reveal that an overvaluation is an error, right?
Yes.
Good. So we've identified the type of what issue here. So this is an error. Overvaluation of closing inventory for 31st December 20x6 at okay. So what type of error is this?
It's accounting policy.
Hey, overvaluation.
Is it
Not period error.
or retrospective?
Overvaluation is not accounting policy. Okay, who thinks it's an accounting policy?
It's not an accounting policy.
It's an error, sorry.
Prior
An error. Yeah, so what type of error? Prior period error, right? And prior period error, how do we treat prior period error? Retrospective or prospective?
retrospective.
Retrospective.
Okay, retrospective. So with retrospective and it affects balance sheet item, you would affect it, and if the nominal impact will be posted to where?
Retain earnings.
Good. Opening retain earnings. All right. Smart. So further investigation shows that there was an overvaluation at 31st December 20. Okay. So overvaluation at 31st December 20x6. There was also an overvaluation at 31st December 20x5 of 120. So according to IAS 8 accounting policies, changes in accounting estimates and error, what adjustment should be made to the profit for the year ended 31st December 20x6 as the comparative figure in the 20x7 financial statement?
So the overvaluation increased the cost, the value of the inventory, and therefore increased the assets, which ultimately increased the accumulated fund. So, or the retained earnings. So that figure should be taken from the retained earnings. So there should be a decrease of the value from retained earnings.
Okay, who agrees otherwise? Yes.
Yes, sir. So I also think the overvaluation of the closing inventory will cause the cost of sales to be small, and then in turn cause overstate your gross profits and then your net profit. So profit has been overstated, which will then add up to the retained earnings, also overstating the retained earnings.
Okay, so we said that prior period errors, right? So prior period errors, if our prior period error is affecting a nominal account, that's the P&L, where should the change, where should we affect the change?
Retained earnings.
Earnings
Where,
and retained earnings.
you know why? Because the 20x6 and 20x5 accounts might have already been issued and signed off. Please, you understand? So you cannot go and take the 20x5 and 20x6 account and adjust the P&L value. I don't know whether you are getting it, because the account would have already been signed already. So if, let's say, I can say that if the years in question, right, if the years in question had happened to be 20x1, that's, let's say, 5 years ago, would we have affected the profit that will be shown in 20x1? No. But the result of 20x5 and 20x6 would have been or will be in the retained earnings. So in the retained earnings, the nominal impact of the overvaluation, once they are corrected, will be what? Will be, how do you call it? Will be posted to the opening retained earnings. Not just any retained earnings, the opening what? Retained earnings. So there will be no what? There will be no change. Not that we will not do any accounting, but for this particular one, in terms of the nominal impact, we are supposed to charge the effect to the opening retained earnings. I don't know whether you are following. Because the nominal, the P&L has already been issued, it's been signed. So those who have seen it, right, those who have seen it are seeing a particular P&L. So a newer P&L, they are waiting to compare it against that P&L. But the opening retained earnings, which has the impact of those prior period P&L that have issues, we can post any nominal impact to that opening retained earnings. Let's go to the second question.
Understood. Sorry, sis. So if I get you, so are you trying to say that there will be no adjustments or anything passed for that year?
For the current year, right? For the
Yes.
current year, if we are doing the prior period error adjustment, right, we would have to debit P&L and credit inventory with valuation.
Okay.
Right, we would have to credit P&L. We have to credit inventory and debit P&L with the overvaluation. The debit P&L, right? The debit P&L is what we are saying that it should rather be debit retained earnings, debit retained opening retained earnings. So the adjustment, I'm not trying to say that there will not be any adjustment. I'm trying to say that what the person is asking from you is that should we pass the P&L adjustment in the current year's FS as if we are doing prospective adjustment? That's what the question is asking you. And the question is also giving you a certain amount. So I used Ebenezer as an example. If he's a finance manager and he had found this prior period overvaluation, do you think that we should decrease this year P&L because we found it this year? That's the question that the question the examiner is asking you. The question the examiner is not asking you, should we do an adjustment or not? No. Should we pass the nominal impact of the prior period errors in this year's P&L? So that's the question. When you read the last part, say, what adjustment should be made to the profit for the year 31st December 20? For the year and the 31st December 20x6 presented as a comparative figure in the 20x financial statement? Because that 20x6 financial statement has already been issued, right? you cannot pass an adjustment to that 20x financial statement, but rather you can pass an adjustment to the retained earnings, because that 20x financial statement, its profit or loss would have been in the opening retained earnings for 20x7. So the accounting entry will be to credit inventory to reduce the inventory value with overvaluation, then debit the opening retained earnings with the nominal impact. Okay.
Okay, thank you.
Sounds about with the second question.
Question
During
2.
the year ended 31st December 20x8, the following event occurred at the Gosselin Company. 1. It was decided to write off 80,000 CU from the inventory, which was over 2 years old, as it was obsolete. 2. Sales of 60,000 CU has been omitted from the financial statement for the year to 31st December 20x7. According to IAS 8, accounting policies, changes in accounting estimate and errors, how much should be shown as a prior year adjustment in Gosselin financial statement for the year to 31st December 20x8?
Yes. Yeah, look at our sisters. Let's start with the sales. Sales for 60,000. And please know that with this question, it's not looking at profit, it's looking at financial statement. So financial statement includes what? Balance sheet. You're looking at the financial statement for 20x8. What should be the prior year adjustment for the financial statement 20x8? For the sales, the omission of sales in the financial statement for the first December 20, how should we treat it?
Yeah,
I mean,
it should be added to the retained ending component since it was omitted from it.
so let's pull double entry. Oh, so I think with this one, we only have one line. So the sales of 60,000 was omitted. So the current year's retained earnings will have to be up by 60,000.
Yes,
so
sir.
you can just say a single omission. Okay. Then the write-off. The write-off. Are we treating the write-off? Look at it. Are we treating the write-off as a prior period adjustment? The write-off. Are we treating the write-off as prior period adjustment?
No.
No.
Why?
Because they decided to write it off in the current year.
Mm-hmm.
So because it is not a change in accounting policy, it is not a change in estimate, it's also not an error.
It's a
So
change in
it
estimate.
has not this.
It's a change in estimate. It's a change in estimate, recoverable amount. If it's not a change in estimate, so it's a change in estimate, how to recover inventory. You can recover inventory by what? By selling. Based on your assessment, the inventory is obsolete. You can't find any value from it. So based on your assessment, you ask, because when I have a PPE, right, I can decide to use the PPE or sell the PPE, right?
Yeah.
For inventory you would want to sell the inventory, but based on your assessment, you value the inventory, and based on that estimation, you realize that you can't get any value from that inventory. So you think the inventory is obsolete based on assessment. You can write, so it is an estimate, Kobina. And because of it's been an estimate, that's why we are treating it as a current year adjustment and not a prior period adjustment. So the question is the question is very interesting. That we are looking for prior period adjustment. So the only one that we can pass as prior period adjustment is what the 60,000 sales that was omitted from what last year's account. If the 60,000 sales was omitted from this year's account, then it will not be seen as prior period adjustment, but rather what current period adjustment. Please do you understand?
Yes, please.
The last question: how should the following changes be treated according to IAS 8 accounting policies? Changes in accounting estimate and error. 1. A change is to be made in the method of calculating the provision for uncollectible receivable. Then 2, investment properties are now measured at fair value, having previously been measured at cost. Okay. So first you have to identify the nature of the change, and you can easily tell whether it is retrospective or what prospective. Okay, so the first one, yes, Basit.
So the first one should be a change in accounting estimates.
The second
And
one.
the second one, yes, should be a change in accounting policy.
Fantastic. One, we just run through. The new standard is not yet in to be effective 2027. So whilst it's not effective, we will still use the IAS 1. The complete set of financial statement, we have present of financial position as at this keyword, as at the year end. Then profit and loss. Please excuse me, give me 2 minutes. Sorry. Okay. So we have 5 set of financial statements: the financial position, the statement of profit or loss, right? This one is one statement. The statement of profit and loss, it ends at net profit. Then we have other comprehensive income, right? It continues after the net profit. Right, statement of changes in equity, then the cash flow, then the note. Okay. Okay, we've seen all this. So this is what the examiner will be looking out for when you are marking your papers. They look for the name of the reporting entity. So once you are preparing any account whatsoever, please try and indicate the entity that you are preparing the account for. If it is group account, you write the name of the group, let's say Q&R group. Then you write the name of the financial statement that you are preparing. If it's a consolidated balance sheet or P&L, you name it accordingly. Then you state whether it's a single entity or it's a group account. The period is also important. So these are things that the examiner is trying to mark whether you are actually applying IAS 1 in your exams questions. So some students will prepare an account without currency. That's terrible. The date of the period, the date of report is also important. You need to cover it. The currency, right? The presentation currency. That's why when you prepare an account and you don't add currency, the examiner does not give you or award you text for currency. Then relevant level of rounding. So if it is a million and you have you sometimes see dollar or Ghana cedis comma either M or K or 3 zeros. That's the level of rounding. You are expected to show that in your presentation. Okay. The one important thing about the definition of assets, the standard defines current assets and says that once it's not current asset, it is non-current. It's only for liabilities. Okay. Now let's go to. These are all non-current asset standards. How many of these standards do you know? Yeah, let me test your prior knowledge. How many of these standards do you know?
Okay, I know of IAS CPPs, IAS 40, investment property, IFRS 5, non-current assets, held for sale, and 38 is intangible assets. And 36 is impairment.
23 is government
Borrowing
grants.
Yeah, there is borrowing cost.
Borrowing cost. And
20
20 is
is
the
government and
Agriculture,
government grants.
36 impairment.
Okay. So should we skip this part and go to? These are interesting feedback. So, in case you've not seen this standard before, right? Just let me just give me a reaction. Because with the way we are going, some are even mentioning they are mentioning standards that are not on the slide. 41. Okay. So, let's go through the concepts briefly. One thing that I would want us to sometimes focus our attention on is the scope of the standard. Right. Some of us are newbies. Oh, okay. No, there's a pre-recorded video for newbies. I'll have all the time for you. Once you listen to the video, please reach out to me and let's have further discussion. Right. I'll not leave anyone behind. The scope of the standard is very important. The scope of a standard tells us how the standard will be applied. So you see, the scope of the standard shall be applied to accounting for property, plant, and equipment, except where other standard requires or permits a different accounting treatment. An entity using the cost model for investment property in accordance with IAS 40, right, shall use the cost model in this standard for own what? Investment property. So I don't know whether you appreciate the scope. And I know you know the standard, but we are being a bit technical. So the scope of the standard is for PPE, but where that PPE, right, a standard requires different treatment, then it will fall under that standard. PPE also includes IAS 40 that we are using the cost model to value. Please note that. So once the item, the investment property in IAS 40, right, we elect to use the cost model for subsequent recognition, then it moves from the IAS 40 towards IAS 16. Okay, note that. Very important. This is the exception of the scope. So the standard does not apply to non-current assets held for sale and discontinued operation because IFRS 5 will handle it. Biological assets because IAS 41 will handle it. Exploration for an evaluation of mineral resources, mining, IFRS 6 will handle it, right? Mineral rights and mineral reserves such as oil, natural gas, and other similar non-regenerative resources like gold, it will be handled by their respective accounting standards. So please note that. Then definition. I told you earlier that we don't say carrying value, but it's carrying amount. The amount at which we would hold the asset in our books, right? And it's usually the asset amount after deducting any accumulated depreciation and accumulated impairment losses. So the cost of the assets is how much we are either constructing or acquiring the assets for. Depreciable value, very important. The amount that we depreciate, or the amount of the asset that can be consumed. So if an asset will last for 5 years, and after 5 years, the asset will still have some value, we say that the depreciable value should exclude that amount. So let me just bring my text box. So the asset cost, let's say 2 million. Its useful life is, let's say, 5 years. But we think that at the end of the useful life, the asset will have 0.5 million after 5 years. So you realize that this asset costs 2 million, but after 5 years, we can still get 0.5 million. It means that the part of the asset that can depreciate is 1.5 million. The 1.5 million becomes the depreciable value, the amount that can depreciate, or the value of the part of the asset that can depreciate. Okay. You can see my textbook. Are you the only one or everyone? I'm not see. Priscilla, can you confirm whether you saw my textbooks?
No, please.
No.
Oh. Okay, but can you see the sign I'm making on the screen?
Yes. Yes.
Oh, okay. I brought a textbooks. What about this red box?
Still.
Okay. Let me. Can we see?
Yes, please.
Yes.
Okay.
Yeah.
Okay. So you have cost 2 million, then the useful life, you said the useful life was 5 years. Thank you for the feedback, Casey. Then after 5 years, we have 0.5 million, right? So it means that the part of the asset that will depreciate is 1.5 million. So the 1.5 million becomes a depreciable value. It becomes a depreciable value. This word is very important. Let's look at the definition here. So expectation, that means an estimate. See, useful life is an expectation. Expectation. Let's note it. All right, so depreciation is just the systematic allocation of the depreciable amount, not the cost. If you see anyone define depreciation as the systematic allocation of the cost of the asset over its useful life, in Canada, it is the systematic allocation of the depreciable value or the amount that depreciates over the useful life. All right, so depreciable value is simply what? The cost of the asset minus any what? Residual value. Okay. At what point in time is the depreciable value equal to the cost of the asset, an asset? At what point in time is the depreciable value of an asset equal to the cost of the asset?
There is no residual amount.
Very good. There's no residual value. It sounds simple, but I was having an ICAG question before, and students under intense pressure, they were seeing rocket science. Well, I'll show you now, or do that dream and say, hey, what happened? Okay. So definitions. We'll be looking at non-current asset, tangible, use of operation and administration. Also, so that's the definition for PPE. Okay, sorry. So they are non-current assets, right? So PPE are non-current assets. We can see and touch them. They are used for operation, administration, or owner use. An example is plant and equipment. At initial recognition, that means when we are bringing them into the books for the first time, right? We saw recognition in the financial framework. We saw recognition. So recognition means that, so there are two types of recognition. We have the recognition that we do now, then subsequently. So please note there are two types of recognition. So they have the initial recognition, that means recognizing the asset or bringing it into the book for the very first time. Then after that, what's next? So after that is what we term as what subsequent recognition. Sometimes the accounting rules for initial recognition and subsequent recognitions are very different. So please take note. Right. So we have initial recognition. So for PP, initial recognition is at what? Initial relevant cost. Right. Please repeat after me. Initial relevant cost.
Initial relevant cost.
That's the end, right? So in the exams, the examiner might want to throw you off by giving you a cost, initial cost, but you would have to assess whether the cost is relevant or it's not relevant. And here we use relevant cost, just like we know relevant cost in managerial accounting. So relevant costs are costs that cannot be avoided and are necessary in bringing the PPE into a condition for use. So if we did a clerical error or blatant error and we incurred costs, even though we have incurred the cost, we will not treat it as the cost of a PPE, we would expense it. So if you are building, let's say, a 3-story office premise, and we made a mistake in the design, and probably that cost us, so we had to break part of the building and redo it again. The cost of material wastage and the cost of those unnecessary, that is coming as a result of the mistake. The question is it relevant cost? Is it the cost that we couldn't have avoided? If we could have avoided the cost, then it's the cost that you have incurred. It will go into your P&L, but it will not be capitalized as part of the value of the asset. So yeah, I don't need ICG question to test you. I only need to tell you that there can be several ICG questions. Now we want to test you whether you know how to find relevant cost to value an initial PPE or recognize an initial PPE. So the catch is what? Initial relevant cost. Right, so in most cases, relevant cost will be made up of historical cost of purchase, right, acquisition, or production or manufacture, right? If, for instance, let me take Danso. Danso is an accountant for a business. He's employed. He's being paid a monthly salary. Then Danso is asked to help research and procure a plant, right? So Danso gets a lawyer to help with the due diligence. He hired, let's say, an engineer to become a technical expert in sourcing for the plant. And at the end of the day, they bought the plant. They incurred freight costs, right? They incurred the actual cost of the plant. The question is, do you think that the cost of the lawyer, the cost of the engineer, and the cost of the plant and the freight should be part of the cost of the PPE? The question that you ask yourself, are these relevant costs, right? Are we incurring this relevant, are we incurring this cost because of the purchase of the plant? Yes or no? Yes, then they are relevant costs. The last question is the salary of Danso a relevant cost to the PPE that was acquired, the plant? Is the salary a relevant cost?
No.
Why?
But the salary do not add any value to the plant.
Okay, that's an interesting way of seeing it. Yeah, who has another way of seeing it?
The organization will still incur that cost regardless of the plant's.
Thank you. It's okay. Oh, so when you start writing the good answer, they said it was okay, then they'll give you your back. And so it's not relevant because whether we buy the plant or not, we will still have to pay a salary. So that's how we have to. So once we know this concept, I don't really care the number of questions I present to you. I know once we are done with this, you should be able to attempt any exam question that is trying to tell you how to value a PPE at initial cost. Okay, so that's fine. I think we can move on. So element of cost, these are the stored elements of cost, right? So it's something straight from the standard. So the purchase price, including import duties, non-refundable tax, purchases, non-refundable taxes, any direct costs attributable to bringing the asset to the location and condition necessary. These are all ways of trying to help you appreciate and understand how to measure initial cost. This one is what directly attribute this thing here. So all this is what I've tried to summarize on the previous page or slide as relevant costs. So all this grammar here is just about what helping you know that it's only relevant costs that we have to consider. There's still relevant cost. Directly attributable means that relevant cost. Okay. So cost not included in PPE, opening a new facility, introducing a new product or service, administrative or general overhead. So Danso salary can be termed as what administrative or general overhead. Then subsequently, after initial recognition, we can either choose the cost model or the evaluation model. This is a requirement or the principle that IAS 16 provides. What do you mean by the cost model and evaluation model? Let's take an explanation. But before, okay. Before we look at the cost model and evaluation model, let's look at some of the PPE classes. So we have land and buildings, machinery, ships, aircraft, motor vehicle, fixtures and fittings, office and equipment. Okay, so now we can now go to the subsequent recognition. Right, so after recognition, we will need to carry the assets in our books at a carrying amount. Right? How do we do that? For the cost model, we say that. Let me bring my test. Yes. We say that the carrying amount right, of an asset is equal to the cost of the asset minus any accumulated depreciation minus any accumulated impairment, right? Now the question will be, how do we calculate or how do we define depreciation, right? How do we calculate or how do we define depreciation? We'll look at that one later on the slide. But for impairment, we'll need to go and study IAS 36. Then we can discuss or we can determine impairment. Okay. But for cost, is it for this three components, right? I don't know whether any one of us is actually following. Is it for this three components? Is it for cost, right? We've already seen cost already. We said cost should be relevant cost. So I think we already appreciate cost, right? So far, we should all appreciate cost. Then for depreciation, I'm saying that we will be looking at depreciation on subsequent slides. For impairment, we would have to go to IAS 36 to look at what impairment. That should be fine. Okay. So let's go on. And look at the revaluation model. Evaluation model is similar to the cost model, but it is this keyword that I would want to bring your attention to, right? This keyword, subsequent. So it's not just accumulated depreciation or accumulated impairment, but rather what precedes it is what I'm very much interested in. It is this word, subsequent, right? And this word, subsequent. It means that at any point in time when we are doing revaluation, right? Anytime we revalue the asset, the revalued amount is treated as a new cost. The old things are passed away. The asset is a new being. So the old accumulated depreciation and impairment are written off. Because after revaluation, the revalued amount is treated as a new cost that is going to be depreciated from the point of revaluation onwards, right? So the depreciation that continues after revaluation is what? It's a subsequent depreciation. That word is very important. It came in one ICAG exams. They did a revaluation. Let me just try and bring some text box here so you appreciate it. Okay, and put it here. So the exam was really interesting. So this is what happened. 31st. Let me just read it. So 31st December, right? 2025. If we do revaluation, right, on a plant, right? If you do evaluation on a plant, the question that I'm going to ask the class, what do you think that on 1st January 2026, the assets will have accumulated depreciation? Yes or no?
Yes.
Okay, so the asset was revalued on 31st December 2025. It's a plant. So I asked, do you think that on 1st January 2026, the asset will have accumulated depreciation? Yes or no? Governor, you answered yes. Yes. Any other?
No.
No. No.
No. Okay. So do we still have Priscilla, yes. Are you answering yes or no?
No, it would have a subsequent depreciation, not an accumulated depreciation.
So on first January 2026, right? Does the asset have an accumulated depreciation on 1st January 2026?
No, it doesn't.
No.
It doesn't. No, it doesn't. So because we did the revaluation on 31st December, right? The revalued amount of the asset as at 31st December which is the same as 1st January 2026,
Now be
is
the
treated
new
as a
cost
fresh
of
cost,
asset.
yet to be depreciated.
Yes.
Right? It's treated as a fresh cost, yet to be depreciated. Hence, on 1st January 2026, the asset has got 0 accumulated depreciation, even though we know that it's going to have what subsequent accumulated depreciation. So that was all the trick that the student needed to excel in that exam. It was a single entity question. So some were looking for accumulated depreciation. They forgot that the asset has been revalued, and because of that, all the prior period accumulated depreciation and accumulated impairment are written off, and asset is now revalued, and the revalued amount is treated as a new cost. So you realize that with revaluation model, the determination of depreciation or computation of depreciation is the same as how we will compute depreciation in the cost model. The computation of impairment loss or the definition of impairment loss is the same as the cost model, but it is the treatment, right? It is the treatment of the revaluation gains and losses that varies, but the determination of depreciation and impairment is the same. Okay. I'm coming in. Okay, so before I go to the depreciation, let's just complete the revaluation. So revaluation is simply looking at the current value, current amount of an asset, right? At any point in time, if you are using the evaluation method, we find the current amount of the asset, and the current amount of the asset will obviously be the cost of the asset minus, let's simplify, minus depreciation minus impairment. Right. I just want to. So current amount is equal to cost, right, minus depreciation minus impairment. Let me just use this. Okay. But this cost here, let me add this. We can all see this S that I've placed here. We can all see it, right?
Yes, sir.
This one. Okay. So this is a simple way of determining current amount. The current amount of an asset, right, is simply the cost of the asset minus depreciation minus impairment. It's as simple as that, right? But if you are finding the current value of an asset is at a specific point in time, we need a date. We can't just say current amount of an asset. No, we would have to express that current amount in terms of what? A date. So the current amount of an asset at a point X, right, is equal to the cost of the asset minus depreciation or accumulated depreciation up to that point that we are finding the current what? Amount minus the accumulated impairment up to the point where we are finding the current what? Amount. I don't know whether that is clear. So if we know the cost and we know how to do depreciation, we know how to do impairment, the focus is that the current amount will always be at a particular date. So your depreciation and your impairment should be accumulated up to that same what? Date. so that when we deduct it from the cost, we will get the current amount as at that particular date. That's the whole trick, right? In this question, I'm a bit well, in terms of the teaching tools, I don't have how do you call it, a stylus pen and a screen to write to make things easier. But there's still a better way of still how do you call it, illustrating issues, trying to help you understand or see my thoughts. One thing that I will always encourage is that please let's come with calculators. We should have our notebooks and our pens ready, right? So at least when I describe a particular transaction, please let's put down the figures and try and attempt it. Okay, I would appreciate that. So if we want to find, let's say, current amount, let's say we have an asset, right? It's an illustration. Let's start. We have a plant. The plant costs 100,000. I want us to all attempt. The plant costs 100,000. The cost of the plant is 100,000. The acquisition date of the plant was 1st January 2020. Okay, I hope you're all following. The estimated useful life, we have 9 years. We have 9 years. No, let's use 10 years. Make our life very easy. 10 years. Okay. We all got a preamble. We all got a preamble. Okay, so it's a plant. There are assets in question is a plant. The cost of the plant is 100,000. The acquisition date is 1st January 2020. The useful life is 10 years. The residual value is 10,000. The residual value is 10,000. One, what's the depreciable value of the assets?
That would be 90,000 also.
Yeah, the depreciable value is 90,000.
Yes.
Please, if you don't answer, just unmute and say it. We don't have time. What's the per annum depreciation?
That would be 9,000.
9,000. Okay. What's the monthly depreciation? Monthly depreciation. What's the monthly depreciation, Ernest?
So I'm coming now.
750.
This land.
750.
750.
That'll be 750, yes.
Yeah, 750. Yeah, 750. Okay.
Yes.
So the depreciable value is 90,000. Depreciation per annum is 9,000. Depreciation per month is 750. Okay.
Yes.
Let's continue. What is the carrying value of the asset? Asset 1st September 2023. The current value of the asset as at 1st September 2023. Yes, I'm waiting.
Please, my
Yes,
network
what's the answer?
was lagging. If you can re-emphasize on what you're asking, please.
What is the current value of the asset as at 1st September 2023? You can't join this class and be a spectator. You have to be involved in the discussion. That way, you realize that you're making tremendous progress. But the preamble was it's a plant. The cost is 100,000. The date of acquisition is 1st January 2020. Useful life, we use 10 years. Residual value, 10,000. First question, what was the depreciable value? We said 90,000. What is the depreciation per annum? We said 9,000. What is the depreciation per month? We said 750. Then the fourth question, what's the current amount of the assets as at 1st September 2020? What? Right. And we are using this knowledge here that the current amount of the assets at date X. So this date X is what? The 1st September 2020, what? 3. We already know the cost. The cost is 100,000. We are not doing impairment. So forget about impairment. So we are finding the total depreciation up to 1st September 2023. That's the focus. Yes. What's the answer? Which one will the answer? Which one will the answer?
27,000.
Come again.
Hello, sir. I got
Yes.
67,000 for the current amount.
Yes, thank you. The current amount is 67,000. Right. So let's do it this way. Let's all try and contribute. These are basic questions. So let's try and hurry up and get the answer so that we can move faster and get to critical issues and attend to the textbooks. Okay. So from 1st January 2020 to 1st September 2023 means that we have 2021, then we have 21, we have 22, right? So that's 3 years. So this is 3 years.
Sir.
Then from, yes.
So I rather got 67,500 because I thought you said 30th September. I didn't have the 1st September.
No, that's fine. That's fine. So if you had to, the whole idea is the principle. Once you understand the principle, I'm okay.
Okay.
I'm okay. So we have covered 2020, 2021, 2022, then 8 months and what? 2023. Right. So 1 month, 1 year's depreciation is 9,000. We have 9 times 3. That gives us 27,000. That's accumulated depreciation as at the beginning of what? 2023. The 2023, we are looking at 9 months, 8 months depreciation. But we already computed per month depreciation to be what? 750. So multiply 750 by what? By 8. That gives us 6,000 plus the 27,000. Gives us the accumulated depreciation of 33,000. We don't take it out of the depreciable amount, we take it out of the cost. So you realize that what we see here, right? Realize what we see here. What we see here, it's cost and not depreciable amount. Please note that. Okay. So I don't know, we all understand how the 67,000 was ascertained, right? We all know how the 67,000 was ascertained, right? Well, let's hurry up. We have 80 minutes. Well, let's hurry up. Let's participate. We all know how the 67,000 was ascertained, right?
Yes, please.
Yes, please. Yes.
Okay. Okay. So this 67,000, if we are revaluing this 67,000, right? If you are revaluing 67,000, we only have what, two options. If you are revaluing, we only have two options. It's either we don't revalue and leave it as what, 57. The third option is not an option. That's to leave it at 57. That means you didn't do anything. So in revaluing, you realize that we can either revalue this 67,000 either upwards or what, downwards. Do you understand?
Yep.
Revalue means that we have now assessed the value of the asset, and we think that the asset value is either more or less than what we already have. That's all about revaluation. Do you understand?
Yes, please.
Okay. So we all agree that we have 67,000. Right? We all agree that we have 67,000 as the current amount of the plant. So if we are supposed to revalue, right? If we are going to do the revaluation on 1st September 2023, it means that there are only two options available to us. It's either we revalue upward or revalue downwards, and the treatment will vary. Do you get it? The treatment will vary. Okay. Let's look at the accounting entries when we are doing evaluation upwards or downwards. But the asset double entry is basic, so that one should not be a problem, right? So if we have 67,000, that's the value of what, of an asset, right? Please do you understand? We said that if assuming we revalue the asset to, let's say, 70,000, it means that we are moving the current amount or the book amount from 67,000 towards 70,000. So what do we do? Because we already have the 67,000 in our books, what do? We would have to debit the asset with what? 7,000, right? You have to debit that with 7,000. Did you get it? For the credit, let's ignore the credit. I'm not interested in the credit, right? I'm only interested in the entry tax. Come again.
How many 3,000?
Sorry, 3,000. Yeah, thank you. Yes, 3,000. So I said 67 to 70. Yes, it's 3,000. So you debit the assets, because the asset already had a current amount of 67,000. You'd have to debit the asset with what? 3,000. Then we credit something. That let's ignore for now. I'm only focused on the entries that affect the assets on revaluation. Let's get another instance. The assets carrying amount is 67,000, but we decide to revalue the asset downwards to 62,000. Right? With this one, the asset already has a current amount of what? 67,000. So what should we do in order to write down the value of the asset from 67,000 to 62,000? What should we do in order to write down the asset from
6,000?
So we credit the 1,000. So we credit the asset with how much?
5,000.
5,000, right? So here the focus is on the credit, the debits. I'm not looking for the debits now. So you realize that whether revaluation increase or decrease, there's an adjustment that we pass on the asset account, right?
Yes.
Yeah, that's the focus I want to drive at. So whether revaluation increase or decrease, we have established that there is an adjustment that we pass on the asset account, either to increase the value or to reduce the value. Please, you understand?
Yes.
Okay. With this beautiful illustration that we've started, I hope we have the values in place. We have a plant 100,000 at cost. The useful life, the cost or acquisition date was 1st January 2020. The estimated useful life 10 years. The residual value is 10,000. Right. Then we are discussing the current amount of the asset as at 1st September 2023. Right. Okay. So our first point was what was the depreciable value? The second question was, what was the depreciation for the year? The third question was, what was the depreciation per month? The fourth question was, what's the current amount of the asset as at 1st September 2023? And I think we rightly computed it as 67,000. The fifth question I'm asking is, what is the remaining useful life of the asset as at 1st September 2023? What is the remaining useful life of the asset as at 1st September 2023? I want it in years.
That will be 6 years.
4 months.
4 months.
No, I want it in years. I want one
Yes.
the amount, the question in the answer in years.
Six and quarter.
In decimals, please.
In the 6.4 years.
No, not 6.4 years.
6.33.
6.3 years.
Okay. So 6.33, that's fine. Okay, so because let me see. Yeah. The eight months, by the 8 months in terms of years is 0.67, right? 0.67, 0.66. Right. So when you add a 0.66 to 3, realize that we have 3.67. That 3.67, when we take it out of 10 years, we have 6.33. Right. So that's the remaining useful life. I hope we all understand. Okay. With your calculator, right? Take 67,000. Right, take 67,000. Deduct 10,000 from it. What do we have? What do you have?
Please come back.
57.
Take 67,000 and deduct the residual value from it. What would we get?
57,000.
57,000. Divide 57,000 by the remaining useful life in years. Divide 57,000 by the remaining useful life in years. What are we getting?
9,004.73.
9,004.74.
Okay. Because it was 3. Let's divide 57,000 by 6.33333. Let's make it a 3 like 5. And let's see what we'll get.
9,000.004.
Yes, so roughly 9,000, right?
Yes,
and do you know this 9,000? It was the per annum depreciation that we already computed at the beginning of this question, right?
Yes.
Very good, very good. Hope you're all following.
Yeah.
Yes, sir.
Okay. So if you have a fraction, right? The fraction being 57,000, right, over 6.333333. Let me just put it here on the screen so that we can all follow and appreciate. We are doing a evaluation now. No. There's nothing else to do after this. So we are looking at 57,000. This is the numerator divided by 6.333333. Okay. The current value of the asset includes the depreciable, it includes the residual value. That's why we've taken it out, right? Okay. We've seen this fraction, right? This fraction. You realize that this fraction you know that when we increase the numerator, right? When we increase the numerator or when we value the numerator upwards, what will happen to the depreciation? So this formula here is just what finding depreciation, right? Depreciation per annum. I hope you're all with me. So it's just finding depreciation per annum, right? This formula just finding depreciation per annum. So realize that at any point in time when yes, Amidu.
I was not seeing the screen, but I can see it now. Sorry.
You can see it now. At any point in time where we increase this numerator, right, because of revaluation, you realize that the per annum depreciation, what will happen to the per annum depreciation? Will it fall or will it rise? If we increase the numerator, right, would the exactly, so you realize that the per annum depreciation will increase, right?
Yeah.
And if we should revalue the assets downwards, you realize that the per annum depreciation will fall. Do you understand?
Yes.
Good. So we should now at least get to appreciate the fact that the revaluation of PPE has an impact on its subsequent depreciation. I hope that's fine.
Yes, sir.
Yes, please.
Okay. Once we are all in agreement, then I think we can move on. Okay. Okay, so let's move on. So that's it. So the last one, when the PPE is revalued, right? The current amount is adjusted to the revalued. So see, look at this beautiful phrase here. The current amount, that means what we already have in our account, is readjusted to the revalued amount. So the revalued amount is external. You have now determined it. But what you already have in your books is what? The current amount. So when the asset is revalued, you are adjusting the current amount to reflect what? The revalued amount. Just take note. So we'll be adjusting the current amount to reflect the revalued amount. Okay. So accounting for revaluation, but you're looking at revaluation upwards or surplus. So if the asset carrying amount is increased as a result of the revaluation, which we have seen, the increase shall be recognized in other comprehensive income. That means it will come after the net profit because we don't think we can realize it because it's PPE, right? And accumulated in equity and at the heading revaluation surplus. But however, if the increase shall be recognized in P&L to the extent that it reverses a prior period revaluation decrease on the same assets. Okay, that is all. So, on general treatment, revaluation increase is taken towards other comprehensive income. We've already seen the assets part, the double entry impact or entries on the assets. And I said for that one, very beautiful. You were able to articulate it well. So when we said the assets carrying value is 67,000 and we revalued it to 70,000, as what entry should we pass in the assets account? And we said we should debit the assets with 3,000 because we are moving so we should debit the assets with 3,000 because of what? Because of moving the assets carrying amount to the revalued amount. So what happened to that account was for us to debit the assets with 3,000, right? But because it's a revaluation increase, the credit, where should the credit go to? Where should the credit go to? The credit will go to other comprehensive income. But if the asset has got a prior period revaluation decrease or deficit, then we would reverse that deficit in P&L, right? In P&L. And if there's any excesses, we'll bring it to other comprehensive income. It's as simple as that. And so that's it. So the accounting valuation upwards is that the general accounting rule is we debit the PPE, then we credit revaluation surplus in OCI. But if there is a previously recognized revaluation deficit, then what we'll do is that we still debit PPE, then we'll go and credit profit and loss to reverse the previous deficit. And if there's any surplus, we still bring it to the what? Other comprehensive income. Right. I'll share the slide with you. And I'll share the transcript of the Gemini transcript of today's meeting with you as well. We have 2 minutes. Let's wrap up. What about revaluation downwards? Revaluation downwards. We would credit the asset. We've said it, we've already said it. But with revaluation downwards, the asset is what? The debit goes to P&L, right, at impairment loss. But if the revaluation deficit or downwards, it's coming on an asset that has got a prior period surplus, then we have to first charge that surplus with the deficit, right? And if there's any excess, we'll bring it to P&L. The credit always remains in what the PP account, which we already know. Okay. Right. So depreciation is the systematic allocation of the residual value of the depreciable amount of an asset, over its useful life. Okay. Let me just quote the formula for depreciation, then we'll wrap up today's class. So this is the formula for depreciation. You will see two estimates. So depreciation is equal to cost, right, minus estimated residual value divided by estimated useful life. You see the two estimates.
Yeah.
Can we see the two estimates? Very good. It means that if you are given an ICAG question in future and the examiner decides to change the residual value or change the estimated useful life, will you treat it retrospectively or prospectively?
Since they are estimates, you apply them prospectively.
Very good. So since the estimate, you apply them what prospectively. You should realize that the reason why I made us do IAS 8 before 16 is the fact that at least be able to apply the concept of IAS 8 in IAS 16. Okay. Okay, let's continue. The only thing that I want to draw attention to is when should we start and end depreciation. The depreciation of an asset begins when the asset is available for use. That is when it is in the location and condition necessary for it to be capable of operating in a manner intended by management. Okay, sir, explanation where you should know, say, also abrophobia in we call so mega to it said, let me be professional. Sorry. When you look at this explanation, you will know that it's a likely exam question that can test your understanding of when depreciation should start. I don't think you see anything like here. I don't think there's anything like it starts when the asset is being used. Can you see anything like that?
No.
No. So we don't start depreciation when the asset is put to use. There are two different things. Once the asset is available for use, we start depreciation. Depreciating. We don't start depreciating when the asset is put to use. We start it when it is available. This guy here, available for what? For use. That is our key phrase. There can be a critical question where the examiner can give you plenty date and give you the date that the asset was available for use, then tell you that after 6 months, the asset was put to use. I always tell you that I I would want to beg you that it is better to understand the concept like rigidly, so that when we see exam question, we will easily bulldozer our way through the exam questions. Because this one, when it comes to the exams, all that you need to know is that the asset was available for you, so we start depreciation, right? Then when do we stop depreciating the asset? We stop depreciating an asset, that the depreciation of an asset ceases at the earlier of the date that the asset is classified as held for sale, right? And the date that the asset is derecognized. So there are two things. So we stop depreciating when an asset is recognized as held for sale, or when the asset is derecognized. So when we derecognize an asset, we stop depreciating the asset. So I've already said that depreciation is not a factor of usage. That's what you should know. We don't depreciate an asset because of usage. Because yes, whose hand was up? Okay. So however, under the usage method of depreciation, depreciation charge can be Can be zero. When there's no production. Example, some industry, they use the unit of production method for calculating depreciation. So for instance, let me see, for instance, they have a plant. Okay. Let me give you an example. So we are ending our class. Permit me, just give me 6 minutes. Let me wrap up. Okay. So they have a plant. The plant costs $5 million, and the plant is supposed to produce, let's say, 100 million units of a product, right? And the plant is such that the estimated capacity that the plant can ever produce is 100 million. Do you get it? So if in year 1 the plant is used and it produced 1.5 million units, right? It produced 1.5 million units. If we are using the unit of production method for depreciation, we will say that the depreciation for year 1 will be 1.5 million units over the 100 million units. That will give us the depreciation factor. Then we multiply it by the cost of the plant. So with the calculator, you realize that the depreciation factor will be equal to, let's try and calculate, 1.5 million divided by 100 million. That will give us, yes, who has calculated it? What's the depreciation factor for year 1? Who has calculated it? Oh, let's wrap up. Who has calculated the depreciation factor? So I said with some industries, the depreciation method that they use, I think these are specialized industry like the mining. Sometimes depreciation is based on the unit of production method. And I'm giving you an example that, let's say we have a plant that costs $5 million. And based on the plant's design, we said it's able to produce a lifetime capacity of 100 million units. And I go on to say that in year 1, the plant was able to generate 1.5 million units, right? So the depreciation factor is going to be the unit that was produced in year 1 against the remaining units. And the remaining unit was 100 million units. So the depreciation factor is going to be 1.5 million by 100 million. What are we getting?
15.
No, I'm not getting 15. 1.5 divided by 100 is not 15.
That's 0.015.
0.015, and in percentage it's 1.5%. So that's
Yes.
the depreciation factor. Right.
Okay.
So you have 0.015. So that's the depreciation factor. So we multiply this by the what? By the cost of the asset, which is 5 million. That gives us a depreciation of how much for year one? Come again. So that would be so that would be 0.075 million or 75,000. Right, 75,000 or 0.075 million.
75,000.
Yes. So that's the depreciation for year one. But in year two, if we decide not to use the plant, right? If we decide not to use the plant, that is why if we decide not to use the plant, then this however comes in. However, for usage method of depreciation, right, the depreciation charge can be zero while there is no production. So if in year two the plant is not used, you realize that the unit that is produced is what? Is zero. So it means that that year we will compute depreciation, but the depreciation will be what? Will be zero. Do you understand? Yes.
Okay.
So it doesn't mean that we have stopped depreciating. We are still depreciating, but the depreciating charge that we had is zero. It's different from we didn't depreciate. This we depreciated, but the depreciation is zero. Okay, that's that's the third point on the slide. Okay. Let me wrap up.
Okay, sir.
Yes.
So assuming we are using straight line, then the first year was 1.5. If the second year we don't use it, we are going to charge 0. Then if you are going to use it in the third year, it will be another 1.5. So we finish using it.
No. So if we are using straight line, right, then the depreciation is not based or dependent on the unit produced. So whether we produce or not, we will still what? We will still depreciate the assets. So here the depreciation is not based on what? It's not based on production. Right.
Okay.
So unit of production is when it's usually in typical cases where the product or the PPE is its useful life is unit produce driven, right? When you take, let's say, a manufacturing plant, sometimes the way they set out the manufacturing plant, they think that the depletion of the manufacturing plant is not based on years, but it's rather based on its output. And if they're able to estimate the output, then you can use the output to depreciate the plant.
Okay.
Okay.
Thank you.
Please ask your question. We are wrapping up.
And please, does this apply to the machine hours method too?
Come again. Yes. So if you are using machine hours as a basis of depreciating the asset, that's it's still unit driven, right? You think that you want to use the machine hours to determine depreciation. That means if there's no machine hours, there's no depreciation. So that's also what production units.
Thank you.
So some of the depreciation methods are straight line, reducing balance, some of the years they get, and production units. But in most of our exams, the examiner focuses on the straight line, the reducing what balance method. So that brings us to the end of what IAS 16. We will end here. There are pre-recorded videos on this remaining standards. I will try and you realize that our next class is around 29. I will try and upload these pre-recorded videos on YouTube, on our YouTube channel. Please listen to it. Make your question. Come to class like the 29th. When I come, all that we are doing is discussing your question. You've read, you've solved questions here and there. You don't understand. See, to become an interesting class. I know the new babies too are there. They also probably listen to the lecture videos. They also go to YouTube and listen to lecture videos. Come prepared. I'll share the slides with you. You can read the slides. You can research. You can come. Let's have a healthy academic dialogue where the students have actually read. So there's rich discussion ongoing. It's not that one-sided discussion where you come and say it's not prepared. It will not help any of us. Whether you like it or yes, the paper that you pass. If you don't want to pass, I'll come to your dreams and I'll still teach you in your dreams until you pass. So pass the you pass. So let's help each other to have a successful section, right? The fact that it's free tuition does not mean that we are going to compromise on quality. Quality, the teaching is not about the money, it's about ensuring that you have a successful CA journey. That's our focus. So please subscribe to our YouTube channels. I will clean the videos and upload them on YouTube. Listen to it. You have about 8 days, right? That's self-studies. You have a group page. You have about 250 of your colleagues, similar mind, trying to learn ICAG. Form group meetings amongst yourself, right? Solve questions. Come to class, ambush me. We have listened to all your videos. Now, this is the question that we have. Why is it that we debit this and credit that? That's the kind of class I would want to have. And that class, anytime I have such a class for my ICD course, every student will pass. Those that are actively involved in the discussion always will excel. Right? I always tell those students that when they get their award, just give me the money and take the certificate. Right. So please, it's going to be an interesting journey. Please be aggressive, be eager. That's the only way we'll pass. Let's be aggressive, let's be eager, let's study ahead, let's read ahead. And in the guidance framework, I will give you all the slides. I'll share the slides. No, even the slides even uploaded on our Google Classroom. I also upload all the pre-recorded videos. I also upload this live session videos. Listen to it. Go ahead and read wide. Come to class 29th and let's have a healthy discussion. The new babies to please. My number is on the page. As you are reading and as you are discussing, be dropping your questions in my DMs. I will attempt them and share my feedback on it with you. Okay. All right, thank you. Please share for others to join. Our aim is to reach 1,000 young professionals who are preparing for their CA this November 2026. Please share our flyers on your social media page, on your group pages, and encourage people to join. You've had a taste of the first lecture. We didn't compromise on quality. We started on time. Yes, Ruth, please ask your question. So after Ruth asks a question, we are done. Yeah, Ruth, please ask the question.
Next class is 28. I stand to be corrected.
Yeah, okay, that's fine.
Okay.
So based on the timetable, yes, if 28, that's fine. But you have the timetable, right?
Yes, sir. Yes, we have it.
Yes, we have it.
9, so I want to.
Yes, we are waiting for. Please ask your question and let's wrap up. Okay, if there are no further questions, we are ending the class. Thank you very much. Please share, like our social media handles, and I will see you on 28th, right? Yes, 28th. But even though there's this break, there's going to be pre-recorded videos that I will host on YouTube that you will have a lot of time to self-pace yourself and learn, then come prepared. But I'll still go through the standard. I mean, we'll still have live section on this standard. But the one that you could have done better for me is that I shouldn't come to the live section again and come and explain the slide. I've already done explanation. Every explanation that you loved on the live section, I've already done it in the pre-recorded video. What I would want to come and do is come and solve questions with you, right? And how to answer ICAG exam questions. Okay. All right, so thank you. And let's have a good evening.
Thank you, sir. Good
Thank
evening.
you, sir. God bless you.
Thank you very much.
Okay.